You want cash flow in your pocket every month. This is what we live off of, cash flow. Really wealthy people like work for cash flow. Not so wealthy people and high earners even work for money. So they swap their time for hours. So hi everyone, so in this short video I'm going to share with you the 6 golden rules of RPI, remote property investing. So I'm Harvey, I'm a remote property investor, and in this video, as I said, I'm going to share with you the 6 rules. So rule number 1, I'll share with you the rules and then I'll go into detail of what they are. So rule number 1 is low purchase price, like low purchase price single let properties. Rule number 2 is making sure they cash flow. Rule number 3 is high yielding. Rule number 4 is adding value. Rule number 5 is lighter refurbishments. Rule number 6 is being able to be in a bracket where it can be switched from benefits, it can be covered fully by benefits if needed to be. So as I said, my name's Harvey, I'm a remote property investor, meaning that I live in the south and I invest in the north. Why do I do this? Because it's too difficult to find really like good single let properties that stack in the south. And when I say it's too difficult, it's impossible. So a foundation of any portfolio, before you get onto any other streams of income from your property, which I've got multiple streams of income from property, I've got multiple streams of income from different asset class. I've got commercial buildings, I've got HMOs, I've also got letting company, I've also got a company that actually buys properties for investors, and we've just started a new education company. See, Ben's jumped on here. Ben's jumped on with learning with this, and I'm looking forward to working with you, Ben. But ultimately, when you're in property and assets, different asset classes, you want multiple streams of income. But your foundation to all those is single let properties. I see a statistic a little while ago. I'm not sure how true this is, but the statistic said 90% of millionaires made their money, and I think this is in the UK, but I'm not 100%, don't quote me on this statistic, but 90% of millionaires made their money from property. So most of them are people who bought up properties in London, and the growth's gone up through the equity growth. But out of the remaining 10% that didn't make their money in property, 9% of them that made their money elsewhere, like they might have made a tech company or created a company, 9% of them put their money into property afterwards. So that's a massive statistic around property and wealth building. So your foundation of all property is single let properties. So if you want to build up a good portfolio of properties, you want a good solid base of single let property. This is a safe stuff. It's not as sexy as exciting when people start talking about the developments and the bigger sort of stuff, and you can earn this much from one property, but it's just residual foundation. You know, when you look at a house, when you're building a house, building a foundation and looking at the foundation is not the sexy part. It starts looking good when you start putting the kitchens in and putting the interiors in, and this is exactly what you're doing when you're building real wealth in property strategy. So your foundations is your single let properties, and then your like sort of interiors, and you're building up your walls around the house is your other strategies. Like your interior will probably be right when you get to the end of it. Like you might go from single lets to HMOs to service apartments to commercial developments to developing. And the developing stage is the last finishing touches. If you're using building a house analogy, the last finishing touches of when you're putting all the nice little gadgets in there and the nice kitchens, you know. But you couldn't put a kitchen on a bit of land, a nice kitchen on a bit of land, and expect it to be operational without the foundations there first and then without the walls around it afterwards. So single let properties is your foundation without a shadow of doubt. It gives you the residual income, the more reliable income from any other strategies. But the only place you can buy these single let properties is in the north of England or Wales, places like this. And this is why the 6 golden rules for remote investing. If you live in one of them areas, fantastic. You don't need to remote, but you still need to follow these rules even if you live in these areas. So as I said, I'll go into a bit more detail about each rule now. So number 1 is low purchase price. You don't want to be exposing yourself with too much capital, especially in these uncertain times at the moment. But any time when you're building a foundation, being able to buy at low purchase prices, also being able to leverage. So if you was buying, I feel a sweet spot is buying between 70 and 100k. If you can find a location where you can purchase between 70 and 100k, this is low barrier to entry. So low deposits needed for this means that if you bought, even in the Midlands now, you look at more like 200k. So you could buy for every 2 properties, you can potentially buy close to 3 properties with the same deposit money. But definitely for every 4 properties, you would have bought. For every 3 properties, you would have bought pretty much 4. So you're spreading your risk across more. Like you're spreading your risk across more properties, and the barrier of entry, the risk is much lower. So if you've got 15k deposit and something goes wrong, 15k is not as much to recover from as 50k or as 100k, you know. So it's a lower barrier to entry, and it's a lot more easy to recover from. So you always want to look at the downside as well as you want to look at the upside potential from it. So number 2 is making sure it's got a good cash flow. You want cash flow in your pocket every month. This is what we live off of, cash flow. Really wealthy people like work for cash flow. Not so wealthy people and high earners even work for money. So they swap their time for hours. So this is when you read Robert Kiyosaki's book, wealth follows assets. And when you follow assets in wealth, basically what you build up is cash flowing assets. So there's a few types of assets. So you could get assets that's a wine collection. So my mate, he sells, they sell wine, high-end wine, and they've got a big stock of wine, and it's an asset, but it don't give them a residual income. I collect sovereign coins when I'm doing okay. I've not bought one for a little while, but I collect sovereign coins. But they're great assets. Gold's a good assets. It's nice for my savings because it's quite liquid, because you remember, property is not liquid. If you need money quick from property, it usually takes you a while to either remortgage it or sell it. So I don't like cash because one, it's a weak asset, but also I spend it quite easily. You know, if I've got cash in the bank, I'm looking for a new deposit, and I'm investing in my company, or I'm going on holiday. Where with gold coins in particular, it's an asset. I know if I need to cash it, I've got the money back in a week. My mate's a gold dealer, a trader, like he trades in gold and diamonds, and if I need my money back, I can give it to him, and I know in a week's time I've got my money. So it's quite liquid, but it's also a solid asset that grows. So I like it as a little backup saving pot. But the reason I don't put lots into that, and I put more into property, is because it don't give me a residual income. Warren Buffett, I see him saying, talking about this the other day. He said, land, you could buy gold, or you could buy a bit of land, or you could buy gold, or you could buy a house. He said land, but I'm going to say house because I'm talking about houses. So I buy my gold. If I put 15k into gold over 20 years or 100 years time, that gold's going to be slightly worth more because gold does go up in value, but also so is a house. But the difference between the house and the gold is the house will give me a residual income every month. So you want a cash flowing asset. You've got to make sure it's got a strong cash flow. Number three is make sure it's got a high yield. So you want a high yielding property. So not cash flow alone. So you could buy a property around where I live and it give you a high cash flow but a low yield. And Simi, one of my, I'm not sure what to call them, mentees or clients or students, I'm not sure what to call them yet, guys. If somebody can advise me on that, that'd be great. But yeah, Simi, I had my one-to-one call with her yesterday, and she was saying, I can't get my head around sort of yield and difference in cash flow. I said, so the difference is you could buy a property that is in the south, for instance, it might be £500 a month mortgage, and give you, it could rent potentially for £1,000 a month. So it might give you, after your £500 mortgage, after all your fees and accounting for voids and accounting for maintenance, it might give you £400 a month cash flow. So that's quite a good cash flow. But it's where it's got a low yield. If, for instance, if you've got that on a 3% interest rate, this, for example, you're probably getting it lower today, but you've got that 3% interest rate and that doubled, which it could go to 6 quite easily. That's where I stress test all my things, all my yields and all my properties when trying to buy as at 6. But if that doubles to 6, you've then ultimately got a mortgage just £1,000 a month, and it's not covering what you're renting it out for. You're going to be in a loss, because by the time you covered your management fees and all the maintenance, you're in a loss. So that's the difference between cash flowing properties and yielding properties. So if you've got a yielding property, for example, one in the north, so if you bought a property in the north that was a good 8 to 10% yield, very easy to find them in the north. Ultimately, if you've got an interest rate now, say your interest rate on that property is £100 a month at 3%, if that doubles, that goes to £200 a month, and you've rented it for £500 a month, you've still got a good margin in there. And the other thing with the yield is, the other good thing about buying these style ones is, again, it gives you the downside protection. So if you go to a variable rate, variable rates usually around 4 or 5%. So if you hit a variable rate, again, you still got a margin in there. So if it's at 3% now and it goes up to 4, even 5%, you're still only going up maybe £50, £70 more, and you still got a good margin in there. Hence, again, another reason what the golden rules behind buying these low purchase price, high yielding. So number 4 is adding value. You want to add value at the front end. So many people always have this conversation, capital growth versus added growth. I like added growth because I know where I'm at with it. If I went to buy a house, if I bought a house 4 years ago in Basildon, my capital growth would have been nearly nowhere. It's been around 1%. It's been nowhere. Even in London, London's really stalled. So you can't guarantee this growth. So just going after the growth in the south, and it really surprises me still because everybody says, yeah, but you're going to get the growth in the south. The south's not grown. Since they changed the stamp duty, since all the foreign investment stopped going into London and they've done this powerhouse of the north, London, like, it stopped. And you look at the wages, I keep on telling people, if you look at the wages in London, it can't grow off of people's average wage. The only way London carried on growing was from foreign investment, and it stopped coming in from all the taxes. So let's say we have a reform of the tax system, which it don't look like it's on the cards yet, but it might do. But at the moment, let's have a reform. We're not getting growth. The strongest growth in the last 4 or so years has been the northwest in Liverpool and Manchester. It's outperforming London by a mile. Really strong growth. It's like 8% in some years. So it really surprises me. But either way, I prefer adding growth. So the old way I explain this to people is, if I bought a place for 300k in Southend, for instance, not far from me, 40 minutes away, got a property there. If I bought a property for 300k and it went up 10% every year, which is really good growth, in 3 years' time, I'd have 90k. Fantastic. I've got properties in the south that's grown like that, so I'm not turning that away. But then let's take the same comparable, that same money for that 300k house, I could buy potentially 4 properties, maybe 5 properties remotely in the north. And it's, say I bought 5 and I added 20k, so added value. So because you can find motivated vendors, motivated sellers and vendors, they're called vendors or sellers, because you can find these motivated people, you can buy property you can add value to by doing a bit of renovation. Not easy you can in the south. And even if you can find them in the south, there's a lot more margins you can make and also a lot more able to remortgage against that. But if I added 20k to each one of those, I've got 100k. I could probably buy 5 properties in 5 months, or 6 months easily. So in 6 months' time, I've added 100k worth of equity instead of plunking my money in one property that's a low yield, as I explained before, got very vulnerable to interest rate rises. So if I plunk my money in there, hope for 3 years I'm going to get 90k. If I do it correctly in the north, I could get 100k in 6 months. I could also then re-lend against that 100k in 6 months and potentially buy some more properties, you know. So this is the difference between earned growth and capital growth. So you want to be able to add value at the start. Also, going into these uncertain times, you want a bit of buffer in case the market dips or in case the valuations don't come in as strong as you think they're going to come in, you know. So it gives you that margin. Always aim at 15%. At the moment, we're looking at around more closer to 20% because of the current climate we're in with everything. So number 5 is always stick to light refurb, especially when you're doing them remotely and you're not in the area all the time. Stick to stuff that's ideally under 15k, but between about 5 and 10k, and you'll be surprised how much you can get done for between 5 and 10k once you shop around, find the good deals, negotiate correctly, and have the correct negotiation methods with the builders. You know, simple things. I had a builder come to here, we had to get somebody for rated people come out to my house to fix a tap, my home house. I was asking him about a job. I've got my flat in Southend's going empty, needs a refurb, and I was asking him about a job, and negotiation skills work like this. He wanted to go and quote it, and I said, what's your day rate? Oh, I want at least 500 quid a day. I said, okay, I'm not going to waste your time then. But if he had told me 150 a day or 200 pound a day, off the back of that, I could then say, okay, when he quotes a job, how long is that going to take you? And you start beginning to negotiate your way in using little tricks like that, which 1, educates you how long things will take, 2, keeps them in a margin. You've got to remember, a lot of builders probably would do it for the price you would pay, but they try their harm at a bit of a higher price to try their luck. So if you set a ruler, you just set the anchor points into what you would pay, and finding out their questions with them, that sets it in. But when it's at a lower value of refurb, so I call a light refurb anything from 5 to 15k. So we don't want to go into structural loft conversions and things like that. It's just general changing kitchens, bathrooms, things like that. So you keep it at that stage. It's much easier to manage. It adds enough value in them areas to get you the added value, and it's just a lot safer and a lot more downside protection, especially if you tell them you're not paying the last payment until you snag the job. If the job's not done correctly, then ultimately 50% of 5k or 50% of 10k should be able to replace, should be able to put right the job of what's should be able to put correction of the job of how far it's gone wrong, if that makes sense. I'm not sure I actually explained that correctly. So if you told him I'm only going to pay the remaining 50% once it's snagged, and if it's not to the agreed standard, and we use that 50% to actually get it done to the agreed standard, I very much doubt the 50% couldn't get that back to the standard you need it to be at. So it gives you protection. It also gives you, it means they have to chase you rather than you them. But it's just these conversations and negotiating right. But doing this on a lower refurb cost keeps it much more safer, much more easy doing that remotely. Number 6 is being able to be in a rentable bracket that can be covered by housing benefits as well as paid tenants. So ultimately, what you want to know is we're going into this downside, and any time really, if your tenant loses their job, you want to know they can get covered fully by housing benefits, and the house is in them brackets. Gives you that both options, firstly, but secondly, it also gives you the downside protection if somebody loses their job or something goes wrong, they can't pay, so they can get fully covered by benefits. So in my location, a 3-bedroom house is £500 a month. So we buy in them brackets and location where you can get the best style tenants and the best houses for £500 a month. You could buy out property, but yeah, if you can switch it across the benefits. So in my location, as I said, it's £500 a month for a 3-bedroom, 425 for a 2-bedroom. So even then, even if somebody is only entitled to 2-bedroom benefits and they're in a 3-bedroom house, if they lose their job, it's not a long way fall downwards like between the 425 and the 500. But I can buy properties for like 20k for 500 that I could rent to an housing benefits, but the profile tenants don't match me. That's a very sort of entry-level profile tenants, usually drug dealers, people with problems. So buying it around 70k reduces the yield a little bit, but in the long term, you do, on your net yield, if you worked it out, you'll earn more potentially, because you'll get less voids, you'll get less management headaches, you'll get less maintenance. So yeah, that's why I go at that sort of range, but everybody's got their choices on them ranges. So guys, hope you found that useful. So that's the 6 golden rules of remote property investing, RPI. So that is low purchase price, cash flowing properties, high yield, added value to them, light refurbs, and number 6 is making sure they can be covered by housing benefits if needed to. So guys, anybody want to ask any questions about that, just pop them in the comments. If you are thinking of remote investing, just reach out to us. I'm happy to guide you. Don't forget, this Sunday I'll be doing a live video. I've not decided what it's about yet. I usually do a poll, but I've had a bit of a busy week this week. So this Sunday, do a live training every Sunday in this group live, and I'll do a little Q&A at the end. So don't forget to join us there Sunday. I'll announce what it'll be about before Sunday, maybe today or later on. Today I've got some more classes, another online training with my students, mentees. I'm not sure what to call them, clients. So I'm looking forward to that. So I'm going to finish off the prep for that, and yeah, enjoy the rest of the day. So guys, enjoy your day. And remember, if you don't evolve your ideas, you'll never live on your own terms. So evolve your ideas, live on your own terms, and have a fantastic day.